Hello everybody and welcome back. In today's video, we discuss the stock, commodities and cryptos markets right now, including the key levels that you need to be watching over the next 24 hours into the next few weeks. For 11 days now, we've seen risk on, and that has been exemplified by a stock here, which is Apple. But all of a sudden, a few days ago, Cramer came out and said that the bull market is back and the bears are done for. Then we get the long leg doji. Let's talk about what this means for markets. We'll see you soon. So welcome back everybody to our daily show here for the markets close 30th of March 2022. If you like stocks, cryptos or commodities, remember to subscribe and smash the like button today if you find value in the video. So Biden is set to release up to 1 million barrels a day from oil reserves to tame the gas prices. This is what we always suspected may occur. Now the price action's actually been telling us that it's a muddled period of time now for oil, and we'll talk about that more. But let's talk about the actual broader market straight away. What was happening over the last 24 hours of trade? Well, it was mostly risk off. So that means that things like technology, things like financials, and of course the other semiconductors and everything were not doing so well. They were the ones that had a small decline in terms of market movement. If we think about what was occurring, we had IWM, the small market 2000 stocks, many technology and a lot of financials in those declining 2% throughout the day. And we had Nasdaq, S&P 500 and the Dow all going down, though the Dow held much better. And that makes sense when we look at the sectors that were doing well. So energy into the close actually held about 1% against, of course, the Biden news that's now coming out, which is going to probably affect energy tomorrow. We had gold up 1.13, metals and utilities doing well. Isn't it amazing? Utilities is a sector that most people hate almost all the time, yet it's been one of the better performing sectors of the year. Defensive plays still working out here in this market. What wasn't doing well though was things like clean energy, TAN, consumer discretionary, technology. They've had great runs. Is it time for a pullback? We'll be trying to answer that in today's video using a mixture of actionable data, macro, and of course technical analysis. So let's get into some things that we know. One of the big ones, everyone's discussing this, is 2 versus 10-year yield curve inversion. This is a known recession hunter. We call it the canary. Now the problem is that it can take a long time between it inverting and an actual recession. Now we've got to think about what type of environment are we in? Are we in stagflation of the 70s? Are we in inflation of the early 2000s or other periods? What type of market are we in? We know we have a rising rate, but this becomes something that we must work out together over a long period of time. Now, I want to always let everyone know that 2 10-year inversion does not instantly tank markets. In fact, it's highly likely it does not initially do anything to markets, and markets continue to trade their way. This was presented by Gary, a member of the community. I'm going to give him a shout out. And if you want to find out some of these charts, remember, jump into our public Discord or private Discord where we do private streams and everything like that to do with markets, because of course you can get a lot more information throughout being a member of the community. So here we have another exhibit, and I want to just kind of bring this up because it's along the lines of our discussion of March, back of March, into April, possibly weakness in May. So remember, there's a cold adage, sell in May and go away. We'll be talking about that soon, and we have done so for a while. But I want to remind everybody that during bear markets, which we don't know we're in, but obviously we're in an interesting market, the year of the trader, midterm years, there are a lot of bounces. In fact, bounces are traditionally incredibly common, and they tend to be quite large. In fact, sometimes these bounces can be incredible in distance, 19%, 18%. During the GFC, a lot of people didn't trade it. There were bounces many, many times over, and so were bounces present in every other big pullback, things like the tech bust, all of those types of times. So we have to be expecting that there could be a lot of volatility. Now, do we expect April to be good? The stats here prove yes. 15 out of 16 years, that's just the stats. Green for April, very strong. One of the strongest months of the year. And a lot of people are now saying, well, we've exited the correction territory for the S&P 500. Theoretically, usually we have. And at that point, what tends to happen is we tend to see a follow-on effect of bullish movements throughout the year. In fact, the stats present pretty bullish numbers here moving forward to a 1-year pace. But we need to talk about the near here and now. And this is where things get a little bit strange. We've got quarter rebalancing. We've discussed that. Quarter rebalancing has caused all sorts of movements in the market to risk on and people moving around the funds inside of large fund managers, etc., etc. A lot of people, such as Goldman and other people, often look for weakness into the back of March, into the start of April. I saw it on some of their reports. That's something they're looking for. And you know that stats over time, 21 years here of April, tend to say that there can be some weakness in the back of March, which we've only got one more trade day of, into the start of April, but that April tends to be a very, very good month, followed by maybe some weakness near the end, near that sell in May. Now, what else happens in May? We know it's earnings season. Does this make sense to midterm years? Yeah, it does. I mean, we've got the Democratic president involved, second year, new Dem pres. Well, that's the red chart here. What happens? Theoretically, seems to be a bit of a sell at the back end of April, midterms. First term, midterm years, similar kind of reality. Democratic pres midterms, similar kind of reality. All midterm years, similar kind of reality. No, this is just the stats. I mean, it doesn't mean it's going to happen, but if you see the signs, this is a pattern taken since 1946. You can't ignore these stats. You can say, okay, they're there. Do we have any reasons to potentially act upon them? Well, that's something that you'll have to come up with. Obviously, we're here just talking about these markets right now. US 2-year versus 10-year. What's going on? It's close to inversion. I mean, wow, that's close. Now, we know this is a sign. We talked about it before. We won't go into it much more than that, but that's where it's at. Remember, type in US02Y/US10Y to get that on your charts if you need it. Let's talk about the VIX, the volatility index, still dropping, still sitting around 20. Generally, 20 is considered where the bulls and the bears fight it out. Basically, anything under 20 is considered a normal market. Anything above 20 is considered a bearish or fearful market, and we're right around that zone. So if the bears are going to come back in, you would think they may try to do so. Look at this, long leg doji, low, high, open, close, indecision at the 20 level. So the VIX is showing us the market's starting to say, well, what exactly is going on? Another one is gold. So people have been getting bullish on gold, and I think we're now getting amazing structure here. What that means is that if certain things occur in the future, there's a higher probability that certain bull kind of tendencies may move or bear. So if you break underneath these two wicks, what happens at that point? Well, you'd have to think the bears have won and the bears have taken control in terms of technicals here of gold, and they're going to be looking at busting it down. Now that's just underneath 1900 an ounce. Pretty amazing level, certainly something that's worthwhile watching. Now we saw a bullish hammer here and a bullish hammer here and a bit of follow through. If gold's going to do it, it needs to kind of do it now. And what it needs to do is create the double bottom pattern, which obviously will break around 1962. Now we have here the support. The support currently, if we rally through, what is that? It's what we call a double bottom pattern. And that double bottom would kind of proof towards something around that 78.6 fib pullback. So these types of things make a lot of sense. This is what we call market structure proofing. It's something we do like in trading because if we find it, it can help us. Look how well that works. It works right to where we expect the parabolic nature of this market that dumped to potentially come back and then start to struggle a little bit. So gold here, especially if you're a believer in stagflation right now, or even inflationary gold. I don't believe in inflationary gold, but I do think it works well in stagflation. We'll proof that one day on this channel, so remember to subscribe. This is the type of thing that you start to look for. Let's move over to US oil, a very shady kind of trade at the moment. Unfortunately, governments are working against you here. They're trying to get oil down. They're doing their best. I mean, you saw Biden, he's releasing the oil and he's going to release it. And that will mean a drive down in at least short-term price. Now, of course, if everyone else comes to the party around the world and increases supply, OPEC, etc., that will also drop oil. And the charts have kind of said this. They went parabolic, they dumped off, and then they've come back up to what we call a dead cat bounce in this zone. We've been talking about this a while. I think oil is going to become unclear. And a few people might be bullish on oil, fair enough. You might have your reasons, you could be completely correct. But this is a chart that I don't think has that much direction. And that's the problem right now. We need to see, do we have direction? I'm not sure if we do there. Maybe you disagree with me. You can definitely type some comments below. I'm always interested to hear other people's opinions. Remember, never discount someone else's opinion, but you need to formulate your own. It's very important. And then see whether that makes sense or whether it doesn't make sense. Often the simplest things are the best things. And I always have this saying, sometimes the hardest trade to take is actually the best trade. Think about that a little bit. So here is Tesla, 1,110. The resistance that we had based on this previous resistance over here, strange level, 1,110, not 1,100, has become still a big area. And we haven't seen Tesla move into the next level of, squeeze or anything like that. I think bulls will be looking for a breakout of this level. If that occurs during day trading, where's the next target they're going to go towards? Well, it's going to be around that 1,200. That's the clearest level for them to go for. It just makes sense from a technical level. Now, in terms of pullbacks, where do we expect them to go to? Somewhere around 1,000 would make sense because that's previous heavy buying pressure. So if a pullback did occur, would there be buyers at 1,000? I would argue there's some structure around here, previous structure, big psychological, buyers may come back in. If it keeps going down, the next level's around that 945, 950. So for now, it does look like Tesla's stunted. It's sitting at a level. And the market's getting ready to say whether they're risk on or risk off in the next couple of sessions. And I think that's something that's very interesting. What is going to be a leader of that? Well, we've talked about Apple's rise, 11 days straight. Yeah, that's someone pulled the stats. Supposedly, if it had done 12 days straight, that has never happened since 2003. So that's how rare it is. I said I hadn't seen it before, and I meant that. I mean, I've traded a while and I've been in the markets for a long time. I've never seen 11 days straight. So I was, looking at it thinking, I'm not too sure about this. It's not that I don't believe in the rally at the moment. We've presented many good informational statistics with it, and we've been talking about the whole year. We've really said it could be a sell the rumor for the Fed and buy the fact. That's what the stats, that's what the data was telling us. Even the markets were kind of pointing that way. So here we sit, and we've got a long leg doji. We effectively have a high, we have a low, and we have an open and a close similar to each other. We know that this is resistance. Previous resistance could act as support. It did so in the last session. What happens if Apple breaks underneath this? Is that the trigger that pulls the market back down to maybe a very nice level, such as this 168? Well, it certainly could be. And of course, if it comes to 168, do we think there's going to be buyer demand? I'm sure a few people are probably frothing right now thinking, oh, I want to be in that price. And I would have bought that price. Well, where were you a few days ago? Of course, that becomes the thing. When you see something happen, it becomes easier to buy that dip. And then, of course, it becomes scary if it goes too far. But look, it makes sense. That's something that's there. Now for buyers, if it rallies through here, of course, day traders are going to be looking towards the resistance and possibly even all-time highs at that point. So this little weird candle in the middle of nowhere actually could be more important than we think over the next couple of trading sessions, even in the next trading session. Let's take a look at ARK. So this was, of course, hyper stocks were risk on, and they all look relatively good on the charts. In fact, I would argue some of these hyper stocks look the best on the charts from a technical basis. We talked about Twilio, and we'll talk about another one in just a moment, but have a look at this. So it breaks out, it moves up to this resistance, and it sells off. It looks to maybe fill a gap. Maybe we get a little bit of weakness here. If it hovers around this point, is this still relatively bullish on the charts? I would say yes, because it's broken past a previous support level. Now this is ARK, and it's just really more of a guide of hyper stocks doing better. And we've talked about how we figured that out. The 20 moving average was a big deal. And on top of that, always breaking down these downtrends become more bullish. All of a sudden, hyper stocks are on, or at least it looks like it. So we have things like Square as well. Nice consolidation here. And you could go through most of these hyper stocks. This is a Wyckoff accumulation. We've obviously got the Wyckoff max pain here. And it's hovering around that level. 20-50 cross on the two moving averages. That's the 20 is the red, and the 50 exponential is the blue. They're both exponentials if you don't know. And these do look better on charts. They kind of show like they've got risk on them. Obviously, nothing is a sure thing, but they certainly look a little bit better. So let's go over to some of our key indicators of the markets right now. One of them is the DAX, the European market. We saw it break out. It gave us another good bullish day. It then's come back down, and it's tested what is basically some consolidation here from the top down. So the DAX is holding the resistance currently, which is becoming support. Now, this becomes pretty important because right now it's holding up. It's basically saying, okay, risk is on, risk was off, risk is potentially on in the next session. But what happens if it comes underneath here? Is this an early indicator possibly of weakness that will come through to the US market. And I know you don't think it will, but this actually was one of our best indicators for the whole crisis period so far. We've been watching this DAX closely, or the European markets closely, because money flow is very susceptible here to risk. It seems to be that this market is the weakest at this stage. So if we break underneath here, does that start to say, okay, well, maybe we do pull back a little bit here. Maybe we go back down to 14.2. And at 14.2, we're hitting supports on the S&P 500, Nasdaq, etc. Now, if we rally through this point, is that going to be more risk on? You'd probably think so. If this was rallying, Apple was moving through, it presents a better story, yeah? Let's have a look at the Nasdaq. The Nasdaq stopping at this weird hanging man over here. That was a great short, by the way. Hanging man's pretty cool candle. And we have here the resistance, and it's slightly sold off the Nasdaq. Now, I'm sure a lot of you would love to have certain pricing. From a technical level, probably any of you can really spot the level you want to be looking at right now, which is going to be around this zone. Now, why? Because it kind of makes sense. If markets pull back, let's actually do a fib here. Let's bring a fib onto the charts together. Let's do this together. Whoa, 38.2 fib. I love 38.2 fibs. One of the best fibs. Why? 38.2 and 50 fibs, the nice momentum is still there. It's just a healthy, nice, tasty pullback into potentially some further rallies. Are there going to be buyers here? Well, let's stack some odds in your favor. You've got the 50 exponential. You've got the 20 exponential. You have previous resistance and previous supports. You have a 14,400, a lot, and 38.2 fib and all these things. So if it did happen, would that be a zone of interest? I think for many people it would. Now, if you don't see this, which certainly is a possibility here, maybe the market doesn't weaken and it keeps going and it goes on epic rallies, day traders are going to come in and again look at things like Apple, look at things like the Nasdaq, and they're going to say, well, if we make a new high, I think we've got a good chance of getting to the 15.6. Remember, you have to think both ways. You can't be biased. At the moment, the trend is bullish, 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 bullish. Even though Cramer's now on board, he's on board too, the bull train, we still need to realize it is technically bullish. It's due for a pullback, but just because you think it's due doesn't mean it has to happen. Since when do markets have to do what we believe? And that's a really important point there. Let's talk about the SPX. So the SPX bounced off the previous resistance becoming support. Again, in the next session, are these levels going to be pretty important? You would have to think so. This little level here, previous resistance, previous support. If the market comes back down, that will be actually the first kind of reversal rally. So when you think about it, every single time here, we've made new peaks and higher lows, new peaks, higher lows, new peaks, higher lows, new peaks, higher lows. What happens if we do this and we make a new low? Is that a lightning bolt that we always talk about? We teach in our course. If you're interested, fxevolution.com, Ultimate Trading Masterclass, or of course our mentoring program. Yeah, I'll plug it here. Why not? So we have here the peak, the trough, the lower peak, and then the lower trough. So if that occurs, is that the change of trend that we haven't actually seen the whole way through? Yeah, it could be a short-term change of trend. So we've got to consider that that's a possibility. We move back over the daily. Okay, cool. What else would happen if it pulled back? Well, there's going to be super crazy amounts of moving average support here. We've got the 200 daily, we've got the 20, we've got the 50, we've got all sorts of things. Take the fib of the whole thing. That's going to be sitting around there as well with the 38.2. Let's do it together. I mean, after a while, when you trade these markets for a while, you know where the 38.2 is always going to be and the 50, because it's just a 50% pullback of the whole move, yeah? You won't even have to put them on your charts. But absolutely, it's all sitting around that same zone. So a pullback, based on the data, based on the seasonality, could be turning into that bullish kind of trend for April. And it would be healthy if that happened. What's unhealthy is parabolicness that goes into the middle of the sun. Because what happens with parabolicness? When it crashes, it usually is brutal, and then it will rally, and then it becomes a little bit more strange. Now, we know how to deal with that market, but still, it's not ideal. And we would rather deal with ideals than not ideals, yeah? Let's talk about Bitcoin. So Bitcoin's floating around. It's risk on, risk off. Obviously, I see Bitcoin as a risk on asset. So when the risk is on, Bitcoin comes out to play, and it has been playing very well. I think we were probably one of the first to really talk about it over here bullishly, when I have been neutral for a long time. In fact, we were neutral as a community. We were sitting here going, I don't know what the hell's going on. Then technicals showed us the way. They gave us clarity. Fantastic. Good work. Now, if the market does pull back, where do we expect buyers to potentially commit? Probably around that 45, 44 zone. At the moment, are things clear for Bitcoin? Not really. We have 2 rejections off the 200 green line, 48,000. We've got a little bit of rejection here. And of course, we're stuck in there. Now, if we clean this area and bullish up, okay, cool, becomes clearer. When things get clearer, we can look towards the next resistances, potentially 52 there. BTC shorts, these sneaky people, look at them. Sneaky, sneaky, sneaky whales. All of a sudden, the market starts going down yesterday, and for a smidgen, they were like, oh yeah, let's short this. Wow, they are sneaky, I've got to say. But BTC shorts, still low, so still overall bullish for Bitcoin. And of course, that's interesting. But I think where things get even more crazy is when you start to consider what we've talked about for a while now, the rise of Ethereum versus Bitcoin. And if you had been looking at it from that perspective, Ethereum has percentagely been doing better recently. It's been in lockstep for a bit, it's breaking out, and as you can see here, it's going for it. It's trying to get through, causing hopefully a spike in Ethereum versus Bitcoin from a ratio perspective. Now, we've argued this for a while. This is what happens in the crypto market. You must understand it's Bitcoin bunkers, Bitcoin does better, Ethereum jumps, and as most of you know by now, then you start to get the big alts and you get all the weird hypers and all sorts of things that I don't even know what some of them are. But they start to go as well. They all jump, but that's usually the movement that goes through. So hopefully this continues. And of course, when you look at Ethereum on the charts, it does look relatively strong. It's right at resistance right now. It looks a little bit better than the Bitcoin chart, but it will ultimately come with that and the rest of the market. So if you haven't been following us already, come and follow us at FX Evolution on Twitter. We do post there quite regularly, so it's always great. Join us in the Discord rooms. And of course, in terms of news moving forward, you've got some decent news coming out. Core PCE price index for the Thursday, and the Friday over here. Take a look at this one. It's the big non-farm employment change, unemployment rate, and ISM manufacturing PMI. One of the biggest bits of news for the month, and always, I guess you would say, volatile and jumps all over the place. So sometimes you don't want to touch, you just want to watch. Hopefully you had a good day. If you did, fantastic. Give us a thumbs up, and of course, subscribe if you enjoy the videos. We'll see you soon, guys. Bye for now.